Okay, if I were to sum up the Elliott wave model with just two words, I would probably choose patterns and perspective. And on that summary, the most exciting market action right now is actually in bonds, right? Equities might be a close second, but the bond market, the credit markets are just fascinating right now. So I want to put up this chart of treasuries because it shows a lot of perspective. What we're looking at here is a 39-year rise in interest rates from 1942 to 1981. Then that rise was followed by a 39-year decline in interest rates, right? And that decline, we believe, ended in 2020, last year. So that's the perspective we're working with. The right side of the chart shows the pattern. Take a look at those red arrows, right? Historically, when interest rates rise, especially after a significant decline, historically you tend to see major stock market peaks, okay? It happened in 87, yields jumped 26%, stock market crashed 41%. It happened in 2000, yields were up 43%, S&P dropped 51% in 2 years. Happened again in 07, T-bonds jumped about 20% that time. That time bank stocks actually topped early, February. Dow Composite tops in July. The industrials in the S&P held up until October, and then everything crashes, plus 50%. So the pattern, it doesn't always happen, but it happens enough that we should be aware of it. And real quick, don't forget the 1929 top either. This chart doesn't show it, but yields had been steadily rising when stocks topped in September of 29. So that's probably the most famous example of this pattern. But again, it's the perspective that matters too. Without the perspective, you can't see the pattern. And in this case, we've been showing, this decades-long history of interest rates, and the pattern, the chart told us to expect rising rates, and that's what we're getting now. Now let's switch gears a tiny bit because I think the bond market is actually even more precarious today than it was at any of those previous times. The stock market too. The chart I'm going to put up here is a bond market concept called duration, right? I won't go into the math, but duration basically measures the sensitivity of a bond to a rise in interest rates. So this chart I'm putting up is an index, right? It tracks duration of global corporate bonds. It's nearly doubled over the past 20 years. And what that means is that bond prices are much more sensitive to rising rates today than they were 5 years ago, 10 years ago, 20 years ago. Okay? In particular, long-dated debt is especially vulnerable to duration risk, and long-dated debt with small coupon payments is especially vulnerable, essentially because those bonds pay back so gradually. And I want to show an example of that too. This chart here shows a 100-year bond issued by the Republic of Austria. It won't mature until the year 2120, and it pays a coupon of just 0.85%, right? It actually priced at an 8% premium last year during the auction. Then prices jumped 40% over par, and then everything changed, right? In December, prices started to tumble. They dropped back below par in February, and right now they're trading just at par today. So long-dated debt, I think, is extremely risky. Even tiny upward blips in interest rates can send these bonds tumbling. And if yields are now rising long-term, there is a lot of debt out there that is going to lose a lot of value. We've been sounding the alarm on this for a long time, and everything has now begun to move in the anticipated direction. So again, simple charts, lots of perspective, and a pattern that says to be very cautious, both in the bond market and in the equity market.